Hello students. Let us understand about payback period method in this session. So payback period. How long time it takes to recover our investment is called as payback period. So for a business where we inserted some investment for our business, so how long time it takes to recover the actual investment. So that period is basically called as payback. So where it comes under the evaluation techniques of non-discounting category under capital budgeting. So this payback period method, so where we can discuss in two ways. One is uniform cash flow, another one is non-uniform cash flow method. So for this session, we are going to understand about the non-uniform cash flows. But anyhow, we need to know what is this uniform cash flows. So formula for identifying payback period is initial investment divided by annual cash inflow. So initial investment, say for example, if it is 10 lakhs, so that is what the initial investment. Annual cash inflows, why it is represented as uniform cash inflows? Imagine that there are 5 different years. For all the years, say for example, 50,000. For the first year, it is 50,000. And for the second, again 50,000. So for all the 5 years, annual cash inflows will be 50,000. So that is why it is said this, uniform cash inflows. So formula for that is initial investment divided by annual cash inflow. So then how to identify this non-uniform cash flows? So let us understand this with the problem. So where a company has to choose one project, so where we have given with 2 different projects, we need to select the right project which gives the better return. So initial investment, that is the cost of the project, is given here as 15,000. Since it is 2 different projects for each project, so it is said that it is 15,000. So both the projects have to be depreciated on straight line basis, which means that we need to do some depreciation calculation in this problem that we discussed. And next is tax is also given here as 50%. So where we need to use payback period concept towards this project, and we need to select the right project. So which project gives the better result for us, which means the shorter duration. Okay, so how to calculate this? So the data which is given for us is year is for 5 different years, which is given here, and profit before tax and depreciation details is given here for both the projects, that is for X and for Y. So for X, see all the cash inflows is given here. Similarly for Y, cash inflows are given here. So from this data, we need to calculate payback period method. So first we solve for project X. So particulars, since it is for 5 different years, first year, second, third, fourth, and fifth. So first the detail that we need to put is, profit before tax and depreciation and after depreciation. So which is given there in our problem as, so 4,200, 4,500, 4,000, 5,000, and then 10,000. So we'll be inserting all the different data which is given there in our question. That is profit before tax and after depreciation. Next, this profit to be deducted from, the tax. Since in our question, tax rate is given as 50%. So with this profit, we should reduce the tax, that is 50%. So 4,200 into 50%, which gives us 2,100. Similarly, the same process for all the different years. So when we reduce this profit from, when we reduce this tax rate from the profit before tax and after depreciation, we can able to get the data as 2,100, 250, 2,000, again 500, and then 5,000. That is profit after tax. This before tax becomes after tax now. So that data is inserted, and after that, since in our question, So depreciation data is also given here as both the projects have to be depreciated on straight line basis. See here. So with this profit after tax and depreciation, we should also include depreciation. So how this 3000, you know, it is mentioned for all the different years. So 15,000 is what our initial investment, that is the cost of the project, divided by life of the project. So what is the life of the project? That is 5 years. So divided by 5. So that is why we can able to get 3000 for all the different years. So from this, we can able to get the data of annual cash inflow. So by adding these two details, that is profit after tax and depreciation details, we can able to get annual cash inflow for project X for all different years. And next is, so how to calculate this? So payback period now. So far we find out only this cash inflow. Next is how to calculate this payback period. So here is for 5 years cash inflows. So just now we calculated as 5,100, 250, 5,000, 5,500 and then 8,000. Okay. So the next column is cumulative cash inflow. So since it is ununiform cash flows, so we need to add another column like cumulative cash inflow. See, the first row is as it is like 5,100. So and the second row where we need to put us by adding this 5,100 and then 5,250, we can able to get 10,350. Again with this we need to add 5,000. We will be getting 15,350. With this we need to add 5,500. So this is the way to calculate cumulative cash inflows. So far we calculated cash inflow as well as cumulative cash inflow. So now how to find out this payback period. So from this data, we can able to identify that what is our initial investment? 15,000. So between year 2 and 3, we can able to get 15,000. Am I right? See the second year, that is 10,350. And for the third year, it just goes like 15,350. So for year 2, we should stop. So second year, that is confirmed. Okay, between 2 and 3, so some actual data we need to find out. So that is why, so 2 years, yes, plus what is the investment that we need? 15,000 minus, see here, what is the cumulative cash inflow for the second year? 10,350. Okay, so close the bracket, divided by, and see the what is the next cash inflow, that is third year cash inflow, that is 5,000. So divided by 5,000. See here, so that you can able to get 0.93, which indicates like 2.93 years, right? So exactly 2.93 years is what the payback period that we can able to recover our actual investment, that is 15,000. So this is for project X. The same way we need to calculate for project Y. As usual, profit before tax data is given. With the deduction of tax, we can able to get profit after tax. Again, we need to add depreciation. Here also the same 3,000, and we can also able to get cash inflow. Again, we need to calculate cumulative cash inflow for project Y. So different data are given here. So again, see here, for the second year, it is given here as 10,500, and for third year, so it is 17,000. So for second year, that is why it is given here as 2 years plus 15,000 is what our initial investment minus 10,500 is the cumulative cash inflow for second year divided by 6,500. So 6,500 is the cash inflow for the next year, that is third year. So probably we can able to get 0.69, that is 2.69 years. So what is the payback period for project X 2.93 years. Here for project Y, payback period is 2.69 years. So from this, we can able to conclude that project Y gives better return in a shorter duration. So obviously we need to select the project X. Hope you all understand. Thank you.